With the U.S. economy set for growth in 2025, how will rising interest rates, inflation, and shifting market dynamics shape the future of commercial real estate? Well, on today's episode, we're covering the economy and commercial real estate and what the outlook is for 2025. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to the RealWealth Show with Kathy Fettke, the real estate investor's resource.
Today, we are thrilled to have a very special guest joining us. Richard Barkham is Global Chief Economist and Global Head of Research at CBRE. Richard brings a wealth of expertise and insights to the table. And today, we're unpacking CBRE's highly anticipated 2025 U.S. Real Estate Market Outlook Report. From optimism about the U.S. economy to nuanced impacts on inflation, tariffs, and interest rates, this report offers a roadmap for investors and developers navigating a dynamic market. We'll dive into the economy at large and then zoom into commercial real estate and specifically multifamily. So let's bring on Richard. Richard, welcome to the RealWealth Show.
Thank you for having me. I'm delighted to be here.
I have a feeling you're going to help me make the economy sound like a fun thing to talk about today.
Well, I've spent 40 years studying the economy and I've never had a boring day.
Oh,
that can sometimes be a bit of a headache, but it's an interesting, it's an interesting phenomenon to look at.
Well, let's start with your role at CBRE. What do you do there?
So I have three roles. I'm chief economist, and so I look at the global economy and real estate markets. I'm also head of research, global head of research, and head of America's research. CBRE is the world's largest property services company. We've offices in 380 locations around the world. I think probably more than that. My research team is about 650 strong around the world. So, I organize the team. I look at the economics, and we collect a lot of real estate data that we put to the service of our clients.
So your company just came out with a report, and it was pretty optimistic. So for 2025, tell me more about that and why things are looking good for the coming year.
I mean, I think the heart of it all is just the U.S. economy. It surprised on the upside in 2024, and I think it's still growing quite nicely in 2025. And at the heart of that is the American consumer, which has seen good gains in balance sheet. We've had the stock market growth, we've got house price growth, and we're also seeing good earnings, income growth, real income growth, as wages rise faster than inflation for the first time for a while. So I think that the consumer, is not without problems, but is in reasonably good shape, and that's of course driving the economy as a whole. And, we're seeing in corporate earnings, the corporate sector is actually in good shape as well. And I think it looks to us like we'll get, 2.3% GDP growth in 2025. And, a growing economy is good for everybody, and it's also good for real estate.
As you say that, it's kind of interesting because what I've heard is one of the reasons why Trump won the election was because people were dissatisfied with the economy. And yet, when you really look at the data, the job growth has been strong. As you said, wage growth has been strong. So what do you make of that?
I think probably you've got the issue of inflation, was pretty acute, in the period 22, 23 and going into 2024. And I think people had a fresh memory of the inflation and the last sort of 24 months being relatively hard as prices went up. So I think that was a headwind. I'm not sure that the Democratic candidate was probably given enough time really in order to state her case. And Mr. Trump is a formidable and quite brilliant campaigner.
Yeah, especially when you look at the fact that a lot of economists and investors are thinking that actually the Trump campaign would create inflation. So do you see that as an issue with potentially tariffs and tax cuts, things that would actually fuel the economy and could create more wage growth, more inflation? I mean, do you see that as a risk?
I think it is potentially a risk, yes. It depends. We don't know to what degree those policies will be pursued. And I think, Mr. Trump also has, or his administration has, a deregulation agenda, which I think would be quite positive for growth. You've got good momentum in the economy. And I think, we've still got 8 million vacancies, I think, in the US economy. So, the labor market, has weakened, but it's relatively tight. So I think, potentially if we don't have enough workers, then, that could push up wages. And tariffs, depends to what extent they're pursued. A small amount of tariffs, pursued on strategic, important industries, I don't think will cause inflation at all. A more widespread tariff, I think, would have a short-term impact on inflation. But I think, on balance, the consensus is amongst economists that inflation, although it's been sticky, will trend down over the course of 2025, partly due to productivity gains, partly due to, a little bit of easing in consumer demand.
Yeah, that's what's so confusing is I do see those consensus reports too that we would see inflation trend down, and yet there's also group consensus that the Trump administration will be positive for the economy. So it tends to be, at least with interest rates tend to stay elevated when the economy is strong, and I would think also inflation would stay somewhat elevated.
I mean, inflation, in the current inflation, there are still, influences that, from the last 12 months or so. So there's still a portion of inflation that is just, quite a lot of the inflation, current inflation is just catch up. And it's feeding through from the housing market. Some of the current inflation at the moment is actually feeding through from its financial services inflation. And it's as a result of the, last year's stock market strength. Yeah. So I think some of that will drop away. And I think the Fed will remain, focused on its 2% inflation target. And it will keep, it will set interest rates, so that the supply side of the economy comes into balance with the demand side. And as long as it does that, then inflation will trend down. Now, what you might be hinting at is, are interest rates actually going to be higher for longer? And yes, I think they probably will be. We're certainly not going back to the low interest rate era of 2009 to 2019. The economy is just too strong, unemployment is too low, and, the federal deficit is too high. But, so interest rates higher for longer, maybe, the Fed funds probably, some cuts over 25, certainly not the 100 basis points that the markets thought 6 months ago, maybe one or two, possibly three cuts over 2025. And the 10-year Treasury hovering above 4%. Certainly not back down to the average of 1.9% that we saw between 2009 and 2019. So interest rates higher for longer, for sure.
Yeah, and that's what's just been confusing. And I'm guessing that for some people it's wishful thinking, because I just read a report. I think it was Navalier and Associates saying, there's going to be a lot of economic growth under the Trump administration, but the Fed's also going to cut rates 4 times. And I'm like, well, those two things don't generally go together. It's confusing to me.
No, no, they don't. And, there's no free lunch in economics. So, we've got good growth. We've got low unemployment. Finally, I think consumers are getting real income growth. But I think, that keeps interest rates sort of higher for longer.
Yeah. It's a catch-22, right? Because a strong economy usually means higher interest rates. So like you said, you can't have both low interest rates and a booming economy, because then you do run into inflation. So with the expectation that interest rates will stay maybe close to where they are now, how do you see that affecting the commercial real estate sector, where so many loans are coming due, and people and commercial borrowers are having to refi into much higher rates?
Well, I mean, I think there are lots of different aspects of the commercial real estate market. One of the benefits of having a strong economy is that leasing is strong.
Yes.
We follow that very carefully. I think in industrial leasing, it's slightly down on 2023, the 24 closeout, but it's still going to be the third highest year ever for industrial leasing. Office leasing has been weak, but we saw a turnaround in Q3 of 2024. And I think our gross office leasing is likely to be up 8% this year. So finally, all of that strength in the service sector is feeding through into leasing. And we're seeing, and retail is having a moment. I wouldn't say leasing is very strong in retail, but that's not because retailers don't want to expand. That's actually because we don't have enough space in the retail sector. Finally, in apartments, or what we call multifamily, I don't have the Q4 numbers out, but the Q3 numbers were remarkably strong, 150,000 units absorbed. So, anything in real estate where you've got strong demand from occupiers makes the financial side of real estate much easier to deal with. And I think that banks have been very willing over the last, because you referred to refinancing, and loans, are falling due. The pattern of the last 2 years, though, has been for banks to extend those loans, sometimes requiring some equity injection, but where the real estate can actually pay the interest on those loans, as it largely has been able to do, then banks have been willing to extend those loans. And I think there are a lot of loans falling due in 2025 that actually first fell due in 2023. They're now extended into 24, extended into 25, into 24. I think they'll be extended into 26 as well. So I think some of the very negative headlines are not accurate. Over the course of the next several years, we will see a value recovery. That will, make that refinancing job much easier.
So I think to interpret what you just said, the income side of commercial real estate has been improving such that the increase in interest rate is going to be okay. It'll be covered.
That is correct.
Okay, that's a great way to look at it.
Don't get me wrong. There is an issue. In certain cases, banks will have to write off, where the value of real estate has fallen below the value of the loan, write-offs will be required. And owners, will often have to inject some further equity so that banks can maintain the loan-to-value ratio. So it's not a painless process, particularly for banks and owners. But it is not the doom loop, I think, that some people have portrayed it in the press.
Yes, absolutely. Okay, so looking at buyers then, people who are wanting to get in, and I'm sure you're looking at them all the time. If you have so many offices all over the world, you could see what people are buying and selling. So for buyers, are they able to negotiate prices down given the circumstances, given the rising costs, or is it still that stuck market?
I mean, I think, what we have seen for the last 24 months is relatively low levels of transactions taking place in the marketplace. There was an uptick, I think, in the second half of 2024. But I think there still is a little bit of a gap between what buyers, would like to pay for the real estate and what sellers, are willing to release the real estate for. And in one sense, that's bad, but it is also indicative of the fact, the point that I made earlier, that there isn't a lot of stress in the real estate sector, forcing owners to have to sell their properties. But I think with the volatility in the bond market and, the growing realization that I think bond rates are going to trend above 4% and finance is not going to get cheaper. I think that will probably lead to more transaction activity with sellers being a little bit more willing to negotiate their prices down to where buyers, want to bid.
Okay. Yeah, that was going to be my next question in the multifamily demand. It sounds like you already said there's been tremendous demand on the tenant side. So on the buyer of multifamily properties, you're still seeing, I've heard lots of money on the sideline for that, but you're
Yeah, I mean, that's right. There's a huge amount of money on the sidelines. So, and sellers not in any uncomfortable position, leading them to need to sell. I think we will see more movement in the market, with, I think, the flexibility being on the seller side rather than the buyer side. And if you look at, real estate cap rates, which is the ratio of the income to the value of the property, there are good returns to be had. And we've seen maybe 20, 25%, drop in value in the multifamily sector over the last several years. This could be a generational opportunity to acquire real estate and multifamily. It may mean that buyers have to bid a bit more than they're comfortable with. But I think that, even if rates are higher for longer, they're not going to be higher forever. So if you're looking to buy real estate and hold it for 5 to 7 years, I think 2025 is likely to be a good opportunity to acquire real estate.
Yeah, that's what I've been waiting for, but it's kind of like you said, I hear that values have come down, but have they really? Because if owners aren't willing to take the cut, how are you going to find the deal?
Well, we can only go off, but you can't force people to sell.
Right. Another thing is, I know it's market specific, certainly, but there are lots of headlines about certain markets being oversupplied in multifamily because of so much new builds coming on. Has that been absorbed, or is that still an issue?
And it's true. There has been a huge level of construction in the multifamily space. I would put it in context. The United States, given that we don't, build enough single-family homes, given the number of households that are in the economy, the economy is probably short of 3 to 5 million housing units. So we have absolutely had a historically high wave of multifamily construction. But I don't think you'd think overall in terms of homes, the US, is oversupplied. Now that new construction has gone into the Sunbelt states, and we've seen vacancy rise from 4% up to 8%. So it's a big jump. But remember, the Sunbelt states is where the population is moving to. Yes. And construction starts have started to fall. Completions are falling, and we're beginning to see vacancy rates stabilize and start to come down. I think that excess space will be absorbed probably in the next 12 months, certainly the next 18 months, and it's a good time for people to lease. There are some good opportunities to lease out there. And as I say, folks are moving to the Sun Belt. So the excess supply is exactly where it needs to be.
Oh, good. It's just a blip where maybe there was a little too much all at once, but it will get absorbed.
Yeah. If we'd had a situation where it had a jump in unemployment, and people were not feeling confident about the future, then it would be a very different matter. But one of the things that tells me that the US economy is actually doing very well was just 150,000 units let in Q3. You just don't get that level of apartment leasing in a situation where people are worried about the future.
So let's talk about cap rates. A lot of our audience is in 1 to 4 unit housing, rental housing, but I know that we have listeners who are in multifamily as well. And so often when I read pro formas on multifamily, I'm just kind of questioning how they're coming up with their exit cap rate. And certainly with any cap rate, the current cap rate. So where is it today? I know it's a broad question because it's different by market, and how has it changed, and how do you see it changing overall in the next year or two?
Yeah, I mean, I think, I tend to, it's not a perfect, real estate is all about rule of thumb,
Yeah.
and one rule of thumb, it works in certain circumstances, and then you have to adjust and use a different rule of thumb. I tend to look at cap rates as the product of the bond rate plus a spread. So, if you've got a bond rate of a 4% and a spread of 300 basis points, which is roughly the average over time, then that should give you a cap rate of 7%. You might want to, adjust that for depreciation and capex in the pro formas. But I think we would, tend to think that, bond rates are not going to stay at 4. They're probably going to, over 5 years, trend down to 3, something like that. So, if you over a 5-year hold, you can probably take 100 basis points off the cap rate. You may not want to push it further than that. I do think there's room for a slight compression of exit cap rates. Particularly if it's a 5-year hold. I wouldn't go further. I wouldn't go much further than that, though.
Okay. I've never heard anyone put it that way. That's great.
Yeah, residential is a little bit of a special case because, as I've said earlier, that you could get more cap rate compression in certain markets. It's just a massively undersupplied market. There's just not enough housing. But I would say a little room for cap rate compression, not too much in investment portfolios, pro formas.
Which kind of brings us back to what you said before, that this could be really a great opportunity for people if that's the case.
I think so. And let's face it, a cap rate of 7%, that's an income return. And, you've got expenses, of course you have, and you have to say, just, I'm going to, step out of the box here, and, go from being chief economist to just average investor myself. I do wonder, there's more debt in the world than there's ever been. Mm-hmm. If you were to get some sort of financial crisis, which is not impossible, what would you rather have? Your money, in banks or in bonds or in hard assets like real estate? I think there is probably, and if we're looking at inflationary times, real estate cash flows, then they're not a perfect hedge against inflation, but they do track inflation in the longer run. So, there are other reasons, I think, to acquire real estate right now, apart from just the favorable pricing.
Yeah. Okay. All right, Richard. Well, any final thoughts for our listeners? It sounds like overall a very optimistic report for 2025.
Yeah, I mean, I think, just to reiterate, the real economy is quite sound. The global economy is picking up. We have got a period of bond market volatility ahead of us until the new administration's policies settle down and become clear. And let's face it, Mr. Trump will want to pursue growth. He won't want to jeopardize that. So I'm reasonably optimistic on the outlook. But when you get these periods of bond market volatility, they can create opportunities as well. So keep an eye open for opportunities in the next 6 months is what I would say. Oh,
fantastic. Well, we're always got the eye out for opportunity, but in the next 6 months for sure. Okay. All right, Richard, such a pleasure to have you here on the RealWealth Show. Thank you so much.
Thank you for having me.
And thank you so much for joining me here on the RealWealth Show. If you want to hear my housing forecast, there's still a couple of tickets left for our upcoming Passive Wealth Expo. I'll be speaking, giving my forecast. My hubby, Rich, will be giving his Focused Investor Seminar. This will help you get really focused on how you want to build your portfolio for 2025. And then we're flying in 10 different teams from around the country people from those Midwest markets that are so hot, and also the growth markets of Florida and Texas. And believe me, we know how to get into the areas where we're seeing rents rise, not decrease. So if you want to meet property managers from those different areas and property providers, builders, just join us at our Passive Wealth Expo. Just go to passivewealthexpo.com. There's just a few tickets left, I think 5 to be specific, and I hope to see you there.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.